Imagine this. You start with a small investment, maybe just a few $100. It grows and grows and grows until it transforms into a massive pile of wealth. In this video, we're diving deep into the world of investing. We're going to break down the ultimate rules and strategies that have helped countless people achieve financial freedom. By the end of this video, you'll have a clear roadmap to build real, lasting wealth. Let's talk about the most important concept in investing: compound interest. It's the snowball effect of earning returns on top of your returns year after year. Think of it like this. You invest $500 a month starting at age 25 and earn an 8% average annual return. By the time you retire, you'll have over $2 million. But if you wait just 10 years to start, you'll end up with less than half, just under $900,000. Even Albert Einstein called compound interest the eighth wonder of the world. Say you invest $10,000 in the S&P 500 every year for 20 years. With an average return of 8%, you'd end up with over $490,000. The takeaway here is simple. The earlier you start investing, the more time your money has to grow exponentially. The perfect time to start investing was yesterday. The second best time is right now. Now let's talk about protecting your hard-earned money. In the world of investing, diversification is crucial. You wouldn't bet your entire life savings on a single horse race, would you? Of course not. Instead of putting all your money into one stock, bond, or real estate property, you spread it across different asset classes. We're talking stocks, bonds, real estate, ETFs, maybe even a little gold or crypto. Different asset classes perform differently in various market conditions. For example, during the 2008 financial crisis, a well-diversified portfolio would have significantly outperformed one heavily concentrated in just a few stocks. A classic example of a diversified portfolio is the 60-40 split: 60% in stocks for growth and 40% in bonds for stability. Diversification helps protect your wealth from the inevitable ups and downs of the market. It's like having a financial safety net so you can sleep soundly at night knowing your investments are working hard for you. Now, let's talk about a strategy that takes the guesswork out of investing: dollar cost averaging. One of the biggest mistakes new investors make is trying to time the market. Even the pros can't predict the market with 100% accuracy. Instead of trying to time the market, you invest a fixed amount of money at regular intervals, regardless of the market conditions. Imagine two investors, both starting with $10,000. Investor A goes all in at the market peak. Investor B uses dollar cost averaging, investing $1,000 every month for 10 months. When the market dips, Investor A sees their portfolio value plummet, while Investor B buys more shares at a discount, lowering their average cost per share. Over the long term, dollar cost averaging helps smooth out the market's volatility. You can't control the market, but you can control how and when you invest. Dollar cost averaging is a simple yet powerful strategy that takes the emotion out of investing and puts the odds in your favor. Alright, let's talk about risk and reward. In investing, higher risk often comes with the potential for higher returns. Are you comfortable with the possibility of losing some money in exchange for higher returns? Or do you prefer to play it safe? It's essential to understand your own risk profile. One of the best ways to manage risk is to have a solid emergency fund in place. By understanding the relationship between risk and reward, and using the right tools to manage your risk, you can make informed decisions that align with your financial goals. Now let's talk about tailoring your investments to your specific needs. Your investment portfolio shouldn't be a one-size-fits-all approach. This is where asset allocation comes in, deciding how much of your portfolio to invest in different asset classes based on your age, risk tolerance, and financial goals. A 20-year-old just starting out can afford to take on more risk because they have more time to recover from any potential losses. They might choose a more aggressive portfolio, heavily weighted towards growth stocks. On the other hand, someone nearing retirement would likely opt for a more conservative approach, with a larger allocation to bonds and other fixed-income investments. By regularly reviewing and adjusting your portfolio, you can ensure that it's always aligned with your changing financial needs and goals. Let's talk about leverage. Leverage can be a powerful tool for building wealth, but it can also be incredibly dangerous if used incorrectly. In simple terms, leverage is using borrowed money to amplify your returns. Think of it like this. You want to buy a rental property that costs $200,000. You could save up the entire amount and buy it in cash, or you could use leverage. Put down a 20% down payment and take out a mortgage for the remaining amount. If the property appreciates in value by 10%, that's a $20,000 profit, but leverage magnifies both profits and losses. If the property value decreases by 10%, you would have lost a significant portion of your initial investment. Avoid high-interest debt like credit cards. Focus on paying off any bad debt before using leverage for investments. Leverage is a tool, not a toy. Use it strategically and responsibly to accelerate your wealth-building journey. Rule number 6. Maximize tax efficiency. No one likes paying more taxes than they have to. There are plenty of legal and ethical ways to reduce your tax burden and keep more of your hard-earned money working for you. One of the most effective ways to do this is by taking advantage of tax-advantaged accounts like IRAs, 401, KAs, and HSAs. These accounts offer various tax benefits such as tax-deductible contributions, tax-deferred growth, or even tax-free withdrawals in retirement. Another powerful strategy is tax loss harvesting, which involves selling losing investments to offset capital gains from winning investments. Holding on to your investments for longer than a year qualifies you for lower capital gains tax rates. Maximizing your tax efficiency is like giving yourself a free raise every year. By taking advantage of these strategies, you can keep more of what you earn and accelerate your journey to financial freedom. Rule number 7. Control emotions and stick to the plan. Investing isn't just about numbers and spreadsheets, it's also about psychology. Our emotions can either be our greatest asset or our worst enemy when it comes to making investment decisions. When the market is soaring, it's easy to get caught up in the euphoria and make impulsive decisions. But when the market corrects itself, those same emotions can lead to panic selling, causing you to lock in losses. One of the most important skills you can develop as an investor is emotional discipline. This means sticking to your investment plan through thick and thin, not letting fear or greed dictate your actions. Look at legendary investors like Warren Buffett, known for his calm and rational approach to investing. By controlling your emotions, staying disciplined, and focusing on the long term, you'll be much more likely to achieve your financial goals. Bonus: the power of learning and giving back. The world of investing is constantly evolving. That's why it's crucial to embrace lifelong learning. Stay curious, read books, listen to podcasts, attend webinars, whatever it takes to expand your knowledge. One growing trend in investing is ESG, environmental, social, and governance factors. Another exciting area is AI-driven investing, where algorithms analyze massive amounts of data to identify investment opportunities. By staying informed about these trends, you'll be better equipped to navigate the ever-changing world of investing. And remember, wealth isn't just about accumulating money, it's also about making a positive impact on the world. Conclusion and call to action. The road to wealth isn't about luck, shortcuts, or get-rich-quick schemes. It's about discipline, patience, and following proven strategies. The best time to start investing was yesterday. The second best time is right now. Take that first step today, no matter how small it may seem. Over time, those small, consistent actions will compound into something truly extraordinary. So, what are you waiting for? Financial freedom is within your reach. It all starts with taking that first step and committing to the journey. If you found this video helpful, hit that like button and subscribe to the channel for more videos on building wealth. Now go out there and start building the financial future you deserve.